Good afternoon, everybody. Thank you so much for taking time out of your day to join us for this Q3 market update webinar. The purpose of these videos, as I've done in the past, is really just to be able to disseminate information to you, our clients, and also to the public. So without further ado, I'd love to jump in and kind of go through some of the salient points of things that have happened over the past quarter or so, and a couple prediction of what we think might happen on a go-forward basis. So without further ado, let's jump in. And as always, I'd like to start just by going over kind of the table of contents here. So there's a couple high-level pieces of information that we're going to want to go over on this webinar. Number one is a bit of a coronavirus update. Number two will be a market recap and some predictions on Q4, what that could look like going forward. We also want to be giving you our general market commentary and our recessionary checklist. Some specifics on our investment philosophy. For those of you who are not familiar with how we do things, it is a little bit different. So we want to go over and reinforce that position as well. Also some granular details on what we're buying and what we're selling and what came in and out of the portfolio over the last quarter. And then lastly, but not least, our performance. So without further ado, let's jump in. Okay, so starting off with the coronavirus update. So for starters, what's interesting about COVID-19 is that at this point it has now affected people in more than 180 countries. The USA has literally the most cases on the planet at about 7.5 million, and unfortunately also the most deaths as well at about 210,000. Unfortunately, a lot of this is happening as a result of what we would say to be an inadequate attempt at the government bodies in the US to be able to coordinate the care for its citizens. So that's really, it's just a failure on the government side, unfortunately. The worst states at maintaining and battling this most recent wave of the virus have been those along the Midwest of the United States. So Kentucky, Indiana, Ohio, Oklahoma, et cetera. They're the ones who've been taking it on the chin, frankly, in this most recent wave. Interestingly, though, is the coastal states. So, New York, New Jersey, California, Florida, et cetera, which on the first wave back in March and April were nearly overrun, frankly, have been handling this second wave much, much better and are not seeing the same level of reported cases by comparison. I think it's partially due to, again, their own state-based government bodies handling the lockdown procedures and battling the virus a little bit better as well. I think a lot of the reasons why we've seen an uptick in the number of new reported cases is partially due to what I like to lovingly call corona fatigue. Throughout the course of the summer, people were just being a little bit more relaxed on their comfort level with the virus overall, getting used to what we call this sort of new normal. And also as states sort of reopen their economies as well. For example, Texas, California, Arizona, and Florida became new hotspots as they opened up their economies over the course of summer. So that led to a higher rate of infectivity as well. The most recent uptick in the Midwest has public health officials kind of on lookout for these new hotbed areas. So it's something that's a cause for concern, and we're keeping our eyes on it. Another interesting point is the fact that the number of states have increased their testing capability and their testing capacity, which is also quite positive as well. Not uncommon, that goes really alongside of that, is as you test more, you're going to have more reported cases as well. As of September 21st, the CDC has confirmed that over 104 million people have been tested for coronavirus. And experts are saying that, with the fall flu season that's literally right around the corner, and in some jurisdictions, depending on, if you're living in a colder climate or not, we're in the midst of it right now. So increased testing capacity is going to become increasingly important as the symptoms between sort of COVID-19 and just the regular flu are fairly similar. So increased capacity for testing is going to be vital as we sort of enter into the colder months here. So changing gears here, that sort of wraps up the coronavirus update. Let's go into a little bit on what we think could end up happening here as a result on the Q4 prediction side of things from a market standpoint. So there's kind of four really main hotbed issues that we're keeping our eye on. So number one, as of the date of recording of this, is obviously the US election. And it's not so much the outcome of who we think will win or not of the election. It's really more the changing of power, should there be one. What does that look like? I think has the bigger impact on the market. It's the uncertainty around that transition, if there is one, is going to be the bigger thing that we want to be looking for from a election standpoint. Now, in addition to that, another sort of looming issue that's been the gift that keeps on giving is Brexit right now. So whether there's a deal or no deal as the UK leaves the Eurozone on an official basis, that's going to be an important one for us to watch as well. There's also the biggest one of them all from a market standpoint is the vote on a stimulus package in the United States. That's been basically pushed until post-election. So we want to keep an eye out on, is that going to be sufficient? Right now, I think it looks as though the market is baking in a stimulus package of some sort. So the question is, how big? And lastly, of course, everyone is talking about a vaccine, and the potential for a vaccine is going to be absolutely massive for the world, being able to go into some sort of new normal and sort of lifting some of the lockdown procedures that have been put in place. Certain countries around the world have been put into modified lockdowns as well. The UK, Brazil, up here in Canada as well. We've been in sort of rolling modified versions of lockdowns. So it's something that we're keeping an eye out on, is if a vaccine is being released, what does that look like, and what will be the amount of available doses? So again, just to kind of recap the best and worst case scenario. So best case scenario for Q4 is the US election outcome is known. So whether there is a Democrat in power or a Republican, it doesn't really matter as much. It's more is that going to be known and is it going to be contested is the first one that everyone's sort of looking at. In addition to that, it's whether there's a deal or no deal on the Brexit front is going to be something that's going to be interesting to watch. Of course, U.S. Congress passing more stimulus will have a very, very big impact. And of course, more encouraging news regarding a vaccine will be extremely positive as well. Those are sort of the best case scenario. On the flip side, the worst case scenario is if the election is delayed or disputed is something we're very much watching, and so is the market. A no deal vote on Brexit will be something as well. No additional stimulus. I don't see why they would do that, but it's a possibility. And then, of course, if this second wave of this virus is worse than we all anticipate right now. So time will tell on some of these issues. Now let's switch gears and look back at Q3. How did we actually do? What was that like? I think for the most part, Q3 was very good for the overall broad markets. Really, with the exception of, sort of some small pockets within Europe, which frankly are still kind of reeling with what can end up happening from a Brexit standpoint. So, really globally, it was been a good run in Q3 for the overall global stock markets. On the fixed income front, we are still currently at all-time record lows for interest rates in the United States. And to put it in perspective, if you were to lock up your money in a long-term US Treasury for 30 years, you're only going to be compensated with a 1.56% annualized yield, which is super low. Which really kind of leads you to imagine if you're locking up your money for nearly 3 decades and you're not even going to keep up with inflation. That's not exactly the greatest paradigm to be investing in. Most economies globally, though, experienced an expansion and continued growth. A lot of this could be construed as sort of overflow from Q2 and the massive amount of stimulus that was injected in the global markets at that time. Either way, it's still considered to be positive economic growth for the most part across the board. On the equity front, the third quarter ended, unfortunately, on a little bit of a sour note. September kept up with this reputation of being historically a fairly difficult month. Asian equities performed best in Q3, up nearly 11% over the quarter. And in addition to that, the S&P 500 was up nearly 9% over the quarter as well. So it was a great, great quarter for equities. On the flip side, the UK index was actually down about 3% on maintained and continued Brexit-related concerns. So something that we're still continuing to watch. On the fixed income front, on the other hand, US government bonds have been leading the charge this past year, and they're up nearly 9%. Namely, as investors have been flocking towards safe haven assets. So that risk-off appetite is absolutely still in full swing. This, of course, as you know, bid up bond prices and unfortunately ended up slamming their yields as a net result. So for those of you who don't know, bond prices and interest rates have an inverse relationship. So as interest rates fall, the price of a bond rises and vice versa. And this, of course, is not just a US-based phenomenon. This is basically a global situation right now, whereas most central banks around the world have, frankly, been slashing their interest rates as a bullet that they're firing, frankly, to help stimulate their economies respectively. So That's kind of the big picture overview of Q3. I'm going to hand it over to Grant to get into a little bit more granular stuff with regards to specific markets and also about our portfolios as well. So over to you, Grant.
Thanks, Shiraz. As previously mentioned, Q3 was fairly positive for equity markets, especially in the months of July and August. In September, we started to see some profit taking and potential rebalancing leading up into Q4, which is when the US election is going to take place. Bonds have remained relatively flat. Another risk off asset in gold saw continuous strength during the last 90 days, so Q3 of 2020. Bonds have provided great returns this year, even though it has leveled out in recent months. Both Canadian and US bonds, however, are up over 6% this year. They're having a tremendous year, much thanks to central banks around the world slamming interest rates to combat the economic downturn imposed by the coronavirus. I wanted to take a quick moment to look at the chart that is displaying the first, second, and third quarter of 2020. The three lines towards the bottom are our equity benchmarks, which include MSCI World Index, the S&P 500, which is the best gauge of the US market as a whole, and on the flip side, the TSX Composite Index, which is the benchmark for the Canadian market. Towards the top of the chart, we have gold, as well as 10-year US and Canadian bonds. You can see throughout the first two quarters of 2020, bonds and gold did tremendously well. The year started well for stocks, and it wasn't until the middle of February when the coronavirus started to really take a hold of the North American markets did we start to see sell-offs globally in the equity markets. I believe the top of the market was February 23rd, and then we saw a huge sell-off where the bottom of the market was March 23rd. During that 1 month was one of the most volatile 30 days in the history of the stock market, including the Great Depression in the early 1900s. From that moment on, we've seen a tremendous rebound in virtually all asset classes, especially equity markets globally. Now I want to take a moment to go over our recessionary checklist. Every quarter, major macroeconomic indicators in three major areas are analyzed to help gauge whether we are in an expansionary or recessionary territory, or somewhere in the middle. On the business front, most of North America and parts of Europe saw a rebound in business confidence. This is particularly important to note because a lack of business confidence and amongst business owners, meaning a less willingness to invest in a particular region. During the beginning of the year, as the coronavirus took hold, everywhere flipped into warning territory. No place globally was immune to this. What has been miraculous is the rebound since the depths of March. One important note to make is globally, especially in Canada and in the US, we haven't seen bankruptcy rates to the extent we thought we would. Perhaps in combination with tremendous government support, this is what kept business confidence high even during a global pandemic. In Europe, unlike in both Canada and the US, business confidence has remained quite muted. This is in no doubt to the never-ending Brexit debacle. As mentioned earlier, the no-vote deal, which should be taking place any day now, hopefully, will drive the boat with respect to providing clarity within the UK from an economic and political landscape. For now, uncertainty will remain supreme. And as I like to say, the markets hate uncertainty. Now, as we change gears and we look at the consumer side of the equation, we notice a completely different attitude. Unemployment everywhere has remained nearly at multi-decade highs. To date, nearly 1 in every 10 Americans are currently unemployed. There's not much difference when we look globally. One statistic that we really like to look at, you'll see here in the middle of the chart, is housing starts. Housing starts refer to the number of residential construction projects that have begun in a particular area in a particular month. This can be a great gauge of how a certain economy is faring as far as population goes, and which is a key factor in economic growth in various regions. Outside of North America, especially in Europe and in Asia, we're seeing a lackluster attitude towards building homes at the moment. Confidence amongst US consumers has failed to rebound like it did in Canada. And perhaps that is because of the pandemic or everything we're seeing on the social side of things in the US. Every consumer indicator we follow in Japan is currently negative. This serves as a large warning sign to our investors. The fact that one of the most important economies around the world is seeing housing starts for the last 12 months fall into negative territory, and their unemployment currently sitting at 3% is not good. This is the highest level they've seen since 2017. When looking at financial indicators, we tend to focus on both inflation and in interest rates. Inflation in Canada and the US has rebounded to pre-pandemic levels. This is important because it represents the overall cost of borrowing for things like cars, energy, food, and so on and so forth. Yield curves in Germany and the UK are currently inverted. For those of you who know, that is one of the best indicators that a recession is coming. Brexit currently remains a wild card, and anything can really happen at this point. Now I'd like to take a moment to speak to you all about our investment philosophy and how we run money for our clients. So any good surfer knows it's ultimately the wind that is dictating both their opportunities and essentially their success. Heavy winds create the biggest waves, but at the same time also create the biggest and largest amount of devastation. The surfer's ability to spot large waves is the first step. And this usually means passing up on many smaller waves until they find that right one, that perfect big ticket wave that can change their career. It is now the surfer's job to get into the wave, or the pipe as they like to call it, just long enough to grab that amazing photo or picture, but not long enough to have the wave break on them. This delicate balance challenges even the best surfers in the world. Getting things wrong at this stage can be catastrophic. Just as the best surfers in the world are waiting and wanting those biggest waves, as investors, we typically want the biggest returns. Identifying which investments or waves will be too small to invest in and which ones will ultimately turn into game-changing wins is always half the battle for us. On the next slide, I'll explain to you how we try to predict which investments will be winners versus losers. Large waves that have strong momentum and investments that have strong momentum tend to produce outsized returns. This is what we're looking for here. The length of time the surfer spends in the pipe can be similar to how long we would stay in an investment. We're looking to ride that wave of positive momentum in a given investment as long as possible. The trick with momentum investing comes when trying to identify when the waves will break. As portfolio managers, our goal is to pass upon small waves, identify those money-making waves, and stay in that pipe as long as we can. Once we feel that wave break, we need to move fast. All too often with investments, people hold on to losing investments way too long and sell winning positions way too quickly. By employing momentum investing, it allows us to stay in winning investments longer than a traditional money manager. In today's world of investing, there's a tremendous amount of noise that exists. From endless amounts of financial magazines, to TV shows, to fake news and political agendas, to social media and headline feeds, we're inundated by the continuous flow of information, some important, most useless. To complicate things further, our biases and personal beliefs often cloud our own investment judgments, especially during times of high stress. For example, during a market crash. After poring over numerous investment research papers and testing various different investment models, some based off instincts, other based off data, we've concluded the best approach to achieve consistent long-term success is to take the human emotion completely out of the equation. This has led us to developing an investment model that utilizes pricing data to take advantage of strong uptrends in different markets around the world, while also managing risk in a particularly thoughtful manner. Many of you who've worked with us have seen this graphic before, which portrays our investment process in 4 simple steps. The first step is really to gather a pool of uncorrelated diversified products. Whether it be mutual funds, hedge funds, ETFs, or stocks, we're looking to collect as many investable options for our clients as possible. From here, we're basically implementing a momentum screen, as I previously discussed. Once we know who is in and out of the portfolio, we need to establish some ground rules. It isn't enough to simply find the investments with the greatest opportunity to make money. We must also ensure we are managing the risk that comes along with such positions. Some of our clients are very conservative. Others are very risky. We must ensure that each and every single client gets a portfolio and thus investment experience that is tailored to their specific situation. The last step, the weighting, is when we can take the investment that scored well from a momentum perspective and adjust the sizing of the position to ensure we're meeting a particular risk level. Going through this process every month is very important. The world is always changing, and so too should your portfolio. Replicating this process monthly and targeting a specific risk profile allows our clients, which have different risk profiles, to own similar products, but still have their experience tailored to their comfortability for risk. Now I'm going to take a moment to discuss some of the buys and sells we've recently made. First, I'll discuss some of the key buys and sells in our sustainable equity model. Ritchie Bros is an auctioneer house that sells heavy industrial equipment and trucks through live and online auctions. This is one of my favorite companies over the last quarter. It's actually headquartered here in Canada in Vancouver, but has operations in over 40 sites worldwide. Earlier this year in February, in an auction in Edmonton, they saw 70% of their total volume come from online bids. And since then, they have done very, very good job at transitioning to only online bids. And their recent auction in May, 100% of their bid volume came from an online source. During COVID, this has been tremendous for this company. This company is a great example of a firm that's doing well prior to the pandemic, but has adapted even better during it. And with the current landscape, Ritchie Bros is up nearly 50% in the last 3 months and now represents our single largest holding in our portfolio. Procter & Gamble, for those of you unfamiliar with the firm, produces a slew of products you likely use every day, including Pampers, Tide, Downy, Vicks, Tampax, Gillette, even Head & Shoulders. These are staples for all of us. Regardless of whether there's a pandemic or an election taking place, we all need access to these products. Procter & Gamble had a great third quarter, up nearly 17%, and now represents the second largest holding in our portfolio. The last significant buy in our equity model is Alibaba. Alibaba is best described as taking eBay, Amazon, and Facebook, wrapping them into one company and placing that in the world's most populous country, China. The firm had a stellar Q3 and was up almost 36% during those 3 months. But what we have to remember, this is a Chinese domiciled firm. So while there's potentially very, very rewarding returns associated with this company, it does bring its own level of very unique risks we must be cautious of. Sticking with our equity model, these are some of the sells we've been making over the last quarter. Regeneron Pharmaceuticals had a rough quarter, but that was largely in part to a lot of profit taking during the last 3 months because it had been up so much this year. Many of you know the name, as it was the company responsible for giving Donald Trump the experimental antibody that he used to get better. This is a great company and it will likely come back into the portfolio in the near future, but for now, the positive momentum has been muted and likely will be over the next few months. So this is a wait and see position for us moving forward. Newmont, many of you might not be familiar with, but they're actually the world's largest gold mining company, with mines in Nevada, Colorado, Quebec, Mexico, and about 10 other countries globally. In a very similar manner to Regeneron, Newmont had an amazing 2020. It was up 41% in the first couple quarters, but most of that came between January and July. Basically, since then, it's been flat, with a large pullback of about 5.3% in September alone. We love this firm, and if the momentum isn't there, which was the case in Newmont, we will not place your hard-earned dollars into security we think will produce profits. This goes back to what we talk about momentum investing. This is a great company, but the data just does not provide us enough evidence to put capital into for this next month. Activision Blizzard is one of those really, really good COVID stocks that just simply hasn't had a good quarter. Up big on the year, this firm specializes in producing some of the world's most recognizable video games like Call of Duty and Guitar Hero. has trended really sideways since late June. So, as we've done in previous cases, Activision Blizzard is a great firm and a great market and will likely be in the portfolio moving forward. But we need to see a much, much more higher level of momentum before we re-enter a position. This might happen sooner than later, actually, because two of their flagship products, World of Warcraft and Call of Duties, they're set to relaunch their newest versions in late October. If the release goes well, we'll likely see a pop in their stock, and Activision Blizzard could be in the portfolio at the end of Q4. Now I want to take a moment and talk to you about our ETF models, both in Canada and in the US. In our Canadian model, we've recently added iShares Global Agriculture ETF, which invests in companies involved in the production of agricultural products, fertilizers, and chemicals, machine farming, and packaged goods and meats. On the US side of things, we've added Invesco Water Services ETF to our portfolio in October. This ETF invests in companies that create products designed to conserve and purify water for homes, businesses, and industries. Both of these ETFs serve as our alternative equity plays that have very low correlation to traditional indexes like the TSX and S&P 500. Next, we've been starting to add some dividend ETFs to our portfolio. US stocks have been off to the races since basically the bottom of March. While momentum factor has led the way for much of 2020, dividend investing has taken hold in the latter half of Q3. We use two different ETFs to track US dividend-paying stocks. One of which is offered by Dynamics, trades on the TSX under the ticker symbol TXG, is up nearly 10% in the last 3 months and 27% this year. For our clients in our US dollar portfolios, Vanguard's US Dividend Appreciation ETF, which trades under the ticker VIG, is up 10% since July and almost 11% this year. Some of the top holdings of these ETFs include mega cap firms we're all familiar with, like Lowe's, Microsoft, Walmart, Visa, and Home Depot. One of the other big changes to our ETF portfolios is the addition of preferred equities, or often they're referred to as preferreds. Preferreds are shares in company stocks with dividends that are paid out to shareholders before common stock dividends are issued. If the company enters bankruptcy, preferred shareholders are entitled to be paid before other stakeholders. They often offer our clients an ability to generate tax-efficient dividend income while focusing on capital appreciation. Now flipping to the sells, in both our Canadian and US dollar ETF models, Franco-Nevada has been one of the best investments for us in the last 2 years. But after declining more than 5% in both August and in September, momentum, that key factor we're always looking for, has vanished. Franco-Nevada topped out around $220 a share in July and has since retraced to about $184 in today's price. We're keeping a close eye on Franco-Nevada, and I wouldn't be surprised to see if it makes a comeback into the portfolio during the latter half of Q4. Long-term bonds are the second area of what we've been selling. These yields have been historical lows. For example, if you want to lock your money up with the US government for 30 years, you're likely only to receive about 1.6% annually, which won't even match inflation. Bonds, especially longer duration ones, tend to do very well when crises hit and when yields plummet, all of which have already happened in 2020. So every 1% increase in interest rates, for example, long-term US bonds will decline by about 12%. So where's the upside from here? Well, for us, it's very, very tough to see. Long-term US government bonds have returned a measly minus 2% in Q3. Canadian corporate bonds, similar duration, have also lost money in the quarter, down nearly 0.5%. The last section that I want to cover with you all is our performance of all of our models. And towards the bottom here, you'll notice 5 benchmarks that I would like you guys to judge our performance against. The benchmarks, you'll see there's 3 stock market ones, the TSX, the S&P, and the Dow Jones, and then 2 bond, the US and Canadian bond indexes. At the top here, what I want to do is take a moment just to show you what we're looking at. You have per month returns of all of our models, as well as the year-to-date number that is reflected on the far right column. The first 4 models are for our Canadian dollar clients. The next four are for US dollar clients, and we have a sustainable model which is available for both US dollar and Canadian dollar clients. This model has done very, very well this year. You'll see it's up almost 23% at time of recording, which is at the end of September. All of our Canadian dollar models are positive this year. The ability to manage downside has allowed us to return to profitability much quicker. And as any investor knows, it's all about staying profitable, which allows compounding to take place over long periods of time. Thank you for your time. I will slide it back to Shiraz now.
Perfect. Thank you, Grant. I appreciate you going over that for us. So to kind of sum things up for you guys here, Q3 overall was pretty strong. We have a handful of headwinds that we're looking at into Q4 here as well. The virus is unfortunately still here to stay. We're hoping for some positive news going forward. So I really do hope everybody's doing their part and being diligent about being safe out there. I think the one thing that we can say to everybody is this has been a really atypical year. This is not normal. We've had multiple black swan scenarios in the past. This has been unlike anything that we've seen, frankly, over the past 100 years. I've said it before and I'll say it again. March was the single most volatile month in the history of the stock market. If you can go through that, you can go through almost anything. So we appreciate the support that you've put in us as your wealth managers and as advisors. And we're here to help in any way that we can. So we really look forward to continuing to work with you, and we're always happy to answer any questions that you may have. So thank you so much. Please stay safe out there and all the best. Bye for now.